Interest rates are like prices for money. They determine how much it costs to borrow money or how much you can earn by saving it. When you borrow money, you pay interest. This is an additional amount on top of the money you borrowed. This is the cost of borrowing. It's like a fee for using someone else's money. When you save money, you earn interest. The bank pays you for keeping your money with them. This is like a reward for letting the bank use your money. The bank can then lend your money to others. Think of it like renting a car. You pay a fee to use the car for a certain period. You pay a fee to use the car for a period of time. Similarly, interest is the fee you pay to use borrowed money. Interest is like that rental fee, but for money. It's the cost of having access to funds you don't currently have. Interest rates are expressed as a percentage. This percentage tells you how much extra you will pay or earn. For example, a 5% interest rate on a $100 loan means you would pay $5 in interest over a year. This helps you understand the cost of borrowing. Higher interest rates mean you pay more to borrow money. This can make loans more expensive and affect your financial decisions. Understanding interest rates is important because they affect how much money you pay or earn over time. Being aware of interest rates can help you make better financial choices. Banks are like the middlemen for money. They play a crucial role in the economy by managing the flow of funds between savers and borrowers. They use interest rates to make money. Interest rates are the cost of borrowing money or the reward for saving it. Banks charge higher interest rates on loans than they pay on savings accounts. This is a fundamental aspect of their business model. This difference in rates is how banks make a profit. The spread between the interest rates is essential for their financial health. For example, a bank might offer a 1% interest rate on savings accounts. This encourages people to deposit their money, but they might charge 5% interest on loans. This higher rate on loans is how they earn revenue. This 4% difference is the bank's profit margin. It covers their operating costs and generates profit. Banks use interest rates to encourage people to save and borrow. They adjust these rates based on economic conditions. When interest rates are low, it is cheaper to borrow money and less rewarding to save. This can stimulate economic activity. When interest rates are high, it is more expensive to borrow money and more rewarding to save. This can help control inflation and stabilize the economy. Interest rates directly impact how much money you earn on your savings. When interest rates are high, your savings grow faster. This is because you are earning more interest on your deposits. Imagine you have $1,000 in a savings account. If the interest rate is 2%, you will earn $20 in interest after 1 year. But if the interest rate is 4%, you will earn $40 in interest after 1 year. Higher interest rates are better for savers. This is because you earn more money on your deposits. However, when interest rates are low, your savings will grow more slowly. Section 4. The impact of interest rates on loans. Interest rates also affect how much you pay for loans like mortgages and car loans. These rates determine the cost of borrowing money, which can significantly impact your financial planning and decisions. When interest rates are high, loans become more expensive. This means that the amount you have to repay each month increases, putting more strain on your budget. This is because you have to pay more in interest payments. Higher interest rates mean a larger portion of your monthly payment goes towards interest rather than paying down the principal amount. For example, imagine you are taking out a $200,000 mortgage. The interest rate you secure will greatly influence your monthly payments and the total amount you end up paying over the life of the loan. If the interest rate is 4%, your monthly mortgage payment might be $1,000. This rate allows you to manage your finances more comfortably, but if the interest rate is 7%, your monthly mortgage payment could be $1,300. This higher rate can make it more challenging to afford your monthly expenses. Lower interest rates make borrowing more affordable. They reduce the overall cost of the loan, allowing you to save money and potentially invest in other areas. This is because you pay less in interest over the life of the loan. Lower rates mean more of your payment goes towards reducing the principal balance. However, when interest rates are high, loans become more expensive and can impact your budget. It's crucial to consider these rates when planning for significant purchases or financial commitments. Section 5. The role of the central bank. The central bank is like the bank of banks. It sets interest rates for the entire economy. When the central bank wants to encourage borrowing and spending, it lowers interest rates. When it wants to slow down the economy, it raises interest rates. Think of the central bank as a conductor of an orchestra. It uses interest rates to control the tempo of the economy. Understanding how interest rates work is important for managing your personal finances. By understanding how interest rates affect your savings and loans, you can make informed financial decisions that will help you achieve your financial goals.